Well, for more on the state of the consumer, we're joined by Nationwide Chief Economist and Senior Vice President Kathy Bosch-Jancic. Kathy, good to see you. So help us understand the state of the consumer, given what we're seeing now with this very sort of mixed picture for earnings results for retailers.
Yeah, happy to be with you. Well, this consumer is certainly feeling the headwinds of elevated and persistent inflation and also higher borrowing costs, interest rates. But I also think they're feeling, rather confident, even though the sentiment and confidence numbers are weaker. I think they're confident to dip into their pandemic-induced savings, at least the upper middle income and upper income households, because they still have a job and wage gains are still rather strong. So they're willing to dip into those savings, which are still quite substantial, and also rely on credit. Now, we don't think that can persist forever. But I think for now, particularly with yesterday's October retail sales data, it was a surprise. And then the upward revisions to the previous months actually gives us some strong momentum for the consumer going into Q4. But the question is it maintained as we go through the end of the year and into 2023?
And Kathy, where do you stand on that? Because the latest data points have been pretty confusing when you take a look at the retail sales, like you just brought up, but compare that to some of the other sectors of the economy that are clearly slowing down. We were just talking to Jerry Howard about the slowdown that we're seeing in housing. When you take a look, I guess, the assessment right now of the economy, what's your outlook?
Yeah, I mean, the housing sector is already effectively in a recession, has been for a while, and not a surprise, right? It's the most interest rate sensitive sector of the economy. Mortgage rates, up and around still 7%. That's going to weigh heavily on housing activity. But when we move beyond that, we're not really seeing a lot of signs of the economy feeling the effect of tighter monetary policy. And I think it's just going to take time for that to feed through. For instance, the other very interest rate sensitive sector is the auto sector. But right now, that's still driven by supply dynamics, supply and demand catching up. Then it does really higher interest rates. And also the auto sector is also now is bifurcated. It's really catering more to, the upper middle and upper income households because prices have risen so much. But we think it's just a matter of time before all of these factors, high inflation, the Fed very determined to lower inflation. And the only way to do that is to tighten policy even more and ratchet rates up even further. We heard that from St. Louis Fed President Bullard today. He's putting out there somewhere between 5 or 7%. Not that was a forecast, but he said that's not, unreasonable range at this point. So I think, eventually Fed will win and tame inflation. But in doing so, they're going to lower economic activity and growth.
So then, Kathy, as consumers then head into the holiday season, then what are the expectations there, given the earnings that we've already seen so far?
It's a great question in that, the question is, did consumers pull some of their holiday spending forward into October? That's one question. Were some of the October spending, more related to perhaps, what was going on in Florida and need to rebuild down there, and auto purchases certainly could have been boosted by that. We know that retailers have a lot of inventories, both in general merchandise, apparel, and other goods. So it could be that some discounting will help buffer the holiday season overall, and consumers will be incentivized, even though they have tremendous stresses. We'll see these discounts as encouraging, and at least we have somewhat of a moderate holiday season.
Kathy, when it comes to the odds of a recession, where do you stand just in terms of how likely a recession is and how deep a recession could potentially look?
I think the odds, unfortunately, are pretty high because again, the Federal Reserve has told us they're determined to tame inflation. And the only way to do that really is to slow aggregate demand, which is still overall labor market and consumer spending still very strong. And particularly that labor market, if you think about it, households, as long as you have a job, at least if both, if you have a dual income household and both are working, they're going to feel comfortable dipping into savings, maybe taking on more credit. But if there's uncertainty about one of those two, adults, maintaining a job or even getting laid off, then that pent up, pandemic related savings really goes to essential spending, not discretionary. So to us, that's the key. And we think corporate earnings are going to really stumble here. So we see the odds pretty high of recession likely, unfolding in the middle part of the year. And we see it moderate recession.
Hopefully consumers will be bracing for that instead of continuing to dip into their savings. A big thank you there to Kathy Bostjancic for joining us this afternoon.